So now we're going to be doing PF3-40B. So basically this question is going to be asking us about adjusting entries, and then it's going to be asking us the financial statement impact if we did not make these adjusting entries. So let's start with the first requirement here. Journalize the adjusting entries needed and assume that it's just for the end of the year, and these are the only adjusting entries that are being made. So they're going to be yearly adjusting entries. So the first one is the company receives its electric bill on December 20th for $375, but will not pay it until January 5th. So this means we're going to have to create a utility payable, but we're going to have to take this expense. So we're going to have an expense of $375 for utility expense, but since we're paying it after the period is over, we're going to have the utilities payable created instead of, for example, cash. If we just paid this bill, we're not going to be paying with cash. We're going to have this payable, and then this payable will be cleared in the next period on January 5th. So if you look at the options here, the first one, cash paid for utilities, that's not correct because we're not paying it with cash yet. We're not recording a payment of an accrued expense because that would also involve cash. Instead, we are accruing a utilities expense. Okay. Next, purchased a 3-month boat insurance policy on November 1st for $3,600. So we first recorded a debit to prepaid insurance. So that means that an asset called prepaid insurance was created when we basically bought this insurance policy. So let's do some math here. So if we had $3,600 and that was for a 3-month policy, so if we do this divided by 3, that means it's $1,200 per month. And so if we bought it on November 1st, the months of November and December will have gone by December 31st. So we're going to have 2 months of this. So this times 2. So we're going to basically have to take an expense of $2,400 for insurance and reduce our prepaid insurance by $2,400. So let's see how we do that. Basically, we have a insurance expense that we're going to debit $2,400. Oops. And we're going to have to reduce our prepaid insurance. Remember, prepaid insurance is an asset, so it's a debit normal. And if we're going to reduce it, we have to credit it. So we have this $2,400 as a credit to prepaid insurance. So let's look at the options. Paid cash expense, no, that's not correct because we're just basically drawing down on this prepaid insurance asset. Paid insurance in advance, no. So the third one, to record insurance expense, seems like the best option. Okay. As of December 31st, Harrison has earned $1,000 of charter revenue that has not been recorded or received. So basically, we have this company performing and earning $1,000, but it's not actually received the cash. So that should clue you into an account receivable being created, and also a revenue here we see is being earned. So account receivable is an asset, as we know, so it's going to be our debit account, and then revenue is our credit account, and it's $1,000. In our memo, no, we do not collect cash. Okay, that's an option. To record service revenue that was collected in advance, no, that's not correct. We're actually collecting the revenue as cash after the fact, not in advance. So the second one is the best option. Okay. Okay, next, Harrison's fishing boat was purchased on January 1st at a cost of $56,500, and it has a 5-year expected use, and it will have a residual value of $6,500. Determine the annual depreciation, assuming straight line depreciation method is used. Okay, so it's making it a little easy for us because it's saying we bought it at the beginning of the year. So we're basically going to be expensing exactly 1 year of depreciation. So let's see what that amount is. So 56,500 is our purchase price. Our residual value was 6,500, and our useful life is 5 years. So let's do a couple of calculations here. So the amount we need to expense, so this is called the depreciable base. So we have our starting point here of 56,500, and we have our ending point of 6,500, and we're going to do it over 5 years. So how much do we need to expense to get from this starting point to this ending point? It's just the difference. You take the starting point minus the ending point. So we need to expense $50,000 to get from the purchase price to the residual value, and we're going to do it over 5 years. And it's telling us the method is straight line. So basically we're going to be taking the same amount every year. So you just do 50,000 divided by 5. So this is our yearly depreciation. Okay, so now that we've done this calculation, we know per year we're basically going to be expensing $10,000. So let's go back here. So we make sure we put our depreciation expense as our debit and accumulated depreciation as our credit, which is again a contra asset account. So you have 10,000, which we just calculated, 10,000. And this is to not record a disposal, not record a purchase, but to record depreciation. Okay. And then finally, we have on October 1st, Harrison received $5,000 prepayment for a deep sea fishing charter to take place in December. As of December 31st, Harrison has completed the charter. So, and it's saying when the cash was received, assume a liability account was credited. Okay, so what that means is when this $5,000 of cash came in, the actual charter had not been completed, so this business owed somebody $5,000. So unearned revenue liability was created at this time. But now, by the end of the year, the charter has been completed, and so we need to record the revenue and basically eliminate the liability, because what the person paid this $5,000 for, it has now been completed, and therefore the business does not owe this person any services. So how do we do that? Since unearned revenue is a liability and it's credit normal, to reduce it, we're going to have to debit it, and we're also going to have service revenue, which we earned because we've given this customer what they wanted. So when we do that, we basically clear out this unearned revenue, which used to be a $5,000 credit. So when we debit the account 5,000, it goes to zero balance, and then we're adding $5,000 of revenue to our business's income statement. So it's not cash collected because we collected the cash back in October. Accrue service revenue that's collected in advance. So I think the third one is the most relevant one because, again, we collected this cash in advance. Okay, so now it's going to ask us to basically step through and see if we had not recorded the entries, what the effect would have been. Okay, so which specific categories of accounts on the balance sheet? So let's see. In A, we have a liability, and if we did not include this expense, it would have hit our equity. So on our balance sheet, it's going to be liability and equity. So the liability, if we did not include this, we see here that we're increasing our liabilities. So if we did not do this entry, our liabilities would have been understated, and therefore our equity would have been overstated. Because if our assets are constant, then if you're understating your liabilities, since assets equals liabilities plus equity, if you're understating liabilities, that means you're showing too much equity, meaning you didn't include an expense that you should have. So equity was too high, meaning your net income was too high, and your liabilities were too low. Okay, specific category of accounts in the income statement. So again, this is our expense was missed if we didn't do that adjusting entry, and the expense would have been understated because we did not include that expense if we didn't do that entry. So let's see if we got this. Okay, so B, let's see what B was. Insurance expense and prepaid insurance. So prepaid insurance is an asset, so that's definitely going to be affected. And the other side of it was recording an expense, so that's an equity account. And so the asset, if we did not reduce it by drawing it down, it would have been overstated. And our equity would also be overstated because basically assets equals liabilities plus equity. So if you just think about the equation, if your assets goes up, if your liabilities are unaffected, that means the equity has to go up to compensate for the assets going up because they're on different sides of the equation. And so again, we have an expense was not recorded, right? This insurance expense, if we miss it, then we're not including this expense, and that means our expense would be also understated. Okay. C, accounts receivable, asset, service revenue, equity. So it's going to be asset, equity. Again, what are we doing? We're creating an asset here. So if we did not do this entry, if we failed to make this entry, then we would have been understating our assets. And just like this previous one, if we're understating the assets, on the other side of the equation, the equity will also be understated. And so this one, though, if we see here, is affecting the revenue, not expense. This is revenue. And if we did not include it, our revenue would have been understated. Okay. D, expense, which is equity, accumulated depreciation. Remember, this is a little different. This is a contra asset account. Even though it is a credit account, it's still an asset account. So we're going to have equity, we're going to have assets. So if we did not include this entry here, our assets would be overstated because we need to reduce them by the depreciation. So if we did not reduce it, then that means it's going to be too high if we didn't do that adjustment. And so since assets and equity move together, assuming liabilities stay the same, this would have also been overstated. This is an expense because depreciation expense would have been missed, and it would have been understated because we would not have included an expense that we should have. And then finally, unearned revenue, it's a liability, service revenue is equity. So we're going to have a liability and equity. And if we did not reduce this liability, unearned revenue, then it would have been overstated. We would have had too high of a liability. And our equity would have been in the opposite, understated. Because we basically would have missed out on this service revenue that we should have had. So our net income would have been lower. So revenue would have been understated. Okay, so let's see. All right, that's it.